Hello all, good evening and welcome. I am Kabir Sohi from the Corporate Communication team of CareEdge. I welcome you to our discussion today on exploring MSME growth and the evolving micro lab landscape. We sincerely appreciate your taking the time to join us for this webinar. We would like to welcome our esteemed guest speakers for today. Mr. Aseem Dhru, MD and Chief Executive Officer, SBFC Finance Limited. Mr. Arulmany D, MD and Chief Executive Officer, Veritas Finance Limited. Mr. Mohit Sahney, Founder, MD and Chief Executive Officer, Finova Capital Private Limited. This session will be moderated by Mr. Vineet Jain, Senior Director, CareEdge Ratings. We will commence the session with a presentation by Mr. Jitendra Meghrajani, Assistant Director, CareEdge Ratings. This will be followed by a panel discussion and Q&A session. In case of queries, participants are requested to key in their panel. We will take up your queries at the end of the discussion. Now, may I invite Jitendra to make the presentation.
Thank you, Kabir. Good evening to all. Firstly, I would like to extend a warm welcome to all the panelists and the audience to this webinar on exploring MSME growth and the evolving microlab landscape. MSME financing remains a critical pillar of economic growth and employment generation. Today, we have a distinguished panel of experts to share their expertise and on-ground experience. We'll start with a short presentation to set the context. We'll begin with the key insights from the presentation. In recent years, NBFCs have posted higher growth in MSME compared to banks. The share of MSME loans in overall NBFC book increased to 9.1% from 5.9% in FY21. While MSME book of banks has grown slower compared to NBFCs, banks continue to dominate the MSME lending space. This sector continues to present sizable opportunity to the lenders with estimated lending opportunity of 18.3 trillion. MSME segment not only presents significant entrepreneurial opportunity, but also help in creating employment opportunity. The government continue to focus on supporting the growth of this segment. In microlab, NBFCs continue to dominate with a market share in excess of 45%, sequentially followed by private banks and PSU banks. In rupees 10 lakh plus lab segment, private banks lead in the market share, followed by NBFC. We'll also discuss about care-rated microlab NBFCs, which may see a moderation in profitability metrics. Now let's look at the growth trajectory of MSME credit by banks and NBFCs. On the left chart, we can see the growth trajectory of banks and NBFCs. While the MSME credit continues to expand, the pace has slowed. The MSME book of banks saw moderation in growth from 20.7% in FY24 to 10.7% annualized in H1 FY25. While growth rate of MSME book for NBFCs has come down rather sharply from 42% in FY23 to 14% annualized in H1 FY25. This to some extent reflects the slowdown in overall credit growth and perceived concerns over asset quality. The chart on the right, we talk about share of banks and the NBFCs in the respective credit books. While for NBFCs, the share of MSME credit in the overall book of NBFCs has increased from 5.9% in FY21 to 9.1% in H1 FY25, an impressive growth of 50% on a low base. For the banks, the proportion of MSME exposure has remained stable in the range of 16 to 16.5%. In this slide, we see that MSME book of NBFCs on a lower base has been growing faster than banks, both private sector and the public sector. As can be seen in the rightmost chart, the NBFC posted a strong 32% CAGR in MSME book for the 4 years ending March 24 on a relatively low base. The MSME book for private sector on left chart shows CAGR of 20.9%, and the public sector banks on the middle chart show CAGR of 10.4%. Now, specifically for FY24, the private banks have grown their MSME book by 3.1 lakh crore, resulting in 29% of growth. Loans to micro enterprise, which grew by 35.34% from FY23 to FY24, also supported the growth of private banks AUM. We expect the NBFC MSME book to grow by 20% till FY26 while for the private banks and PSBs to grow at 15% and 10% respectively. To enhance the MSME's access to formal credit and strengthen the sector's resilience, the Government of India has outlined the following proposals in the latest budget to support the MSME sector. The Government of India has raised the investment and turnover limits for each category. The investment limit has been increased by 2.5 times and the turnover limit has been double. For instance, for micro enterprise, the investment limit has been revised from 1 crore to 2.5 crore and the annual turnover limit has increased from 5 crore to 10 crore. CGT MSE cover is also proposed to be enhanced to 10 crores from 5 crores. A new mutual credit guarantee scheme is also introduced, offering 60% guarantee coverage for loans up to 100 crores. This initiative aims to simplify the access to capital for MSME, particularly for acquiring the new machinery and equipment. Pradhan Mantri Mudra Yojana refinancing scheme, an increase in CGFMU guarantee cover from 10 lakh to 20 lakh has been positive for the sector. Udyam registration, Udyam Assist, GST Sai, TREDS, and other digital public infrastructure are also helping the sector by better geographical penetration. This slide will discuss how, in spite of various policy efforts, significant opportunities for lending exist for MSME sector. Based on IFC estimates, assumptions around GDP growth, we size the total MSME funding need at 127.5 lakh crore. Leaving aside the funding from equity and the informal segment, an amount of 50.7 lakh crore is addressable through formal funding. The AUM of 32.4 lakh crores leaves a large opportunity of 18.3 lakh crore for formal lending, especially in the micro enterprise segment. Bridging this gap calls for innovative lending models and leveraging digital infrastructure. Over the time, formalization of economy and usage of technology will also bring informal demand into the formal lending. We now switch over to the focus to one segment of MSME funding, which is a lab and a micro lab market. There are multiple definitions of micro lab in this discussion. The micro lab refers to the loan below 10 lakh. On the right-hand side chart, we see that MSME lab market has grown from 7.5 lakh crore to 11.3 lakh crore in 2 years, ending September 24, a 50% jump. Within this, the micro lab segment has also grew from 1 lakh crore to 1.6 lakh crore in the same period, representing slightly higher growth rate of 60% compared to the overall lab. On the left-hand side chart, we can see that NBFCs dominate the micro lab segment with 45% market share, well ahead of private banks, which have little over 25% share. In the 10 lakh plus lab space, private banks have 42% share compared to 37% share of NBFC. In this slide, we present the asset quality data of micro lab and 10 lakh plus lab. On the left-hand chart, we can see the PAR 90 plus numbers are higher for micro lab compared to 10 lakh plus lab segment. This data represents the aggregate data for banks, SFBs, HFCs, and NBFCs lab segment. The PAR 90 levels for loans above 10 lakhs have decreased from 6.0% in September 22 to 3.7% in September 24. Similarly, the PAR 90 levels for micro lab have reduced from 6.7% to 5.6%. The micro lab tend to have higher delinquency for a variety of reasons. This segment has higher new to credit customers, credit evaluation based assess income, limited ability to manage the cash flow mismatch. Thus, the customer profile is expected to have comparatively higher delinquencies. Another observation from Bureau data is a downward trend in PAR 90 levels for both lab and micro lab. This data is a divergence of trend that we observed in NBFCs focused in this segment. This divergence is probably explained by far better asset quality of MSME book of banks. Here we are looking at asset quality data only for the NBFCs. The base data is number of loans and LAR 90, which is defined as percentage of number of loans in 90 plus bucket. The curves here represent 90 plus vintage curve for 10 lakh plus lab segment and the micro lab segment for NBFCs. In the initial life cycle of the loan, the proportion of micro lab in numbers in 90 plus bucket are higher than 10 lakh plus lab segment. In the present data, LAR 90 for micro lab peaks at 44 MOB at 3.4%, and for 10 lakh plus lab segment, it peaks at 3.8% at 57 MOB. The proportion of micro lab loan in 90 plus bucket after 83 months stands at 1.9% compared to 3.3% for 10 lakh plus lab segment. We need to see this data with 2 points in mind. One, the higher LAR 90 for 10 lakh plus lab book for the NBFC probably reflects the higher competition in lab from the banks and resulting from consequent adverse selection. Two, The right-hand end of the microlab curve pertains to data which could be 7 to 8 years old when the base itself was very low, and the back then 10 lakh may not have been micro in some sense. Nonetheless, in the present data, the micro lab has shown better recovery from the peak compared to 10 lakh plus lab segment. We believe that 10 lakh plus lab segment will have a lower credit cost losses compared to the micro lab. In upcoming slides, we look at some of the trends of care-rated entities focused on micro lab. The underlying data covers entities with more than 75% of the book in micro lab. Here, as we can see, these entities have on an average grown at a CAGR of 39% from FY20 to FY24. We expect the AUM of microlab MSME focused NBFCs to grow by 25% in FY25 and FY26. In this slide, as can be seen on the left-hand side, microlab NBFCs have been on expansion mode. Branches have doubled from approx 1,000 in FY21 to over 2,000 in FY24. The growth in branch network is also supported by improvement in branch productivity. Average disbursement per branch has doubled from 5.2 crores to 10.3 crores during this period. These two factors reflect in increasing OPEX for the initial period on the right-hand chart and expected stabilization in OPEX from FY24. Moving on to the profitability metrics, rising competition and the pricing pressure are expected to moderate the NIMs. The cost of borrowings will come down slowly on the back of rate cut expectations. With seasoning of AUM and the customer segment of microloans, the credit costs are expected to rise. Also, the stress in microfinance may lead to higher delinquency on microlab. With this, we expect a slight reduction in ROTA in FY25 and FY26. Here we talk about challenges in MSME and microlab lending. While the microlab segment is growing and the sector is getting support from the formal credit, MSME still faces hurdle in accessing credit. Key challenges includes a large section of MSME still lacks credit history or a financial record keeping, which limits the access to formal credit channel. MSME borrowers tend to have volatile cash flows and could get severely impacted by the sharp turn in business cycles with single source of income. This perceived risk also limits the access to formal credit. Security enforcement as a cause of concern has been addressed by effective use of SARFAESI. Our microlab segment resolutions are largely driven by persuasions due to lack of access to SARFAESI, as also the cost of enforcement, or particularly in less than 5 lakh segment. Microfinance is going through its own journey due to over-leveraged borrowers. We understand that microlab may have 15 to 20% overlap. Lenders need to be prompt and cautious in spotting the over-leverage at a borrower level. This brings us to the last set of presentation. We expect the MSME book and the microlab book to grow at 14% and 25% in FY25 and 26 respectively. We expect slight spillover of stress in MFI and unsecured loans to microlab. We expect the credit cost to go up marginally in FY25 before slight reduction in FY26. We also expect slight moderation in ROTA for microlab focused NBFCs. For microlab focused NBFCs, in the terms of opportunities, deeper branch penetration, digital transformation, co-lending, and a continuous access to equity funding will drive the lending growth. We expect the continuous focus of the government on the employment generation will support the MSME lending and will also improve the access of formal credit to NTC customers. We have now come to the conclusion of our presentations. Thank you, and I would like to hand it over to Kabir.
Thank you, Jitendra. Attendees are requested to key in their questions, which we will take up after our panel discussion. Now, may I invite Vineet to take over the session, please? Vineet is the Senior Director at CareEdge Ratings. He is a Chartered Accountant and Company Secretary. He has 25 years of experience spread over credit rating, structured finance, debt capital markets, and corporate banking, including NBFC lending and portfolio buyouts. He was part of the founding team of IDFC Bank and was instrumental in setting NBFC lending business as part of FIG, Financial Institution Group. He has earlier worked with SBI Capital Markets, Axis Bank, etc. Over to you, Vineet.
You're on mute, Vineet.
Wait 1 second. Am I audible?
Yep.
Yeah. Thank you, Jitendra, and good evening to all the esteemed panelists and all the participants. A very warm welcome to all of you. We are honored to have today 3 esteemed panelists, and I thank each one of them for being part of this panel discussion. I believe we all will benefit from their valuable insights. Please note that views expressed by the panelists are their personal views and may not necessarily reflect the official views of the institute that they are associated with. I now quickly introduce our panel members. Our first panelist is Mr. Aseem Dhru, Managing Director and CEO, SBFC Finance Limited. Mr. Dhru has over 25 years of experience in banking and finance. He is currently MD CEO of SBFC Finance Limited and has been associated with SBFC since September 2017. Earlier, he was associated with HDFC Bank as Group Head, Business Banking, Working Capital, and Retail Agri-Businesses. He has also served as MD and CEO of HDFC Securities Limited and was on board of HDFC Financial Services Limited. Aseem is a commerce graduate. He also holds a couple of professional degrees, chartered accountancy and cost accountancy. A very warm welcome to you, sir.
Thank you. Thank you. Thank you for having me.
Our second panelist is Mr. D. Arulmany, founder, MD, and CEO of Veritas Finance Limited. Mr. Arulmany holds bachelor's degree in business administration from Madurai Kamraj University and a postgraduate diploma in rural management from Institute of Rural Management, Anand. He has also completed a global program for management development from University of Michigan Business School, Michigan. He has over 25 years of experience in financial services industry. Previously, he was associated with Aptus Value Home Finance Limited as president and CEO, and also was associated with Cholamandalam Investment and Finance Company as chief marketing manager marketing. A very warm welcome to you, sir.
Thank you, Vineet. Thank you.
Our third panelist is Mr. Mohit Sahney, founder, MD, CEO of Finova Capital Private Limited. Mohit is an engineer and MBA by qualification. He also has 25 plus years of experience in rural banking and financial services. He had a opportunity to look at full spectrum of assets and liabilities businesses from business conceptualization, development to risk management in number of products such as home loan, mortgage business, property services, agri business, business loan, rural assets, branch banking, etc. Previously, he has served as JGM in ICICI Bank. A very warm welcome to you also, sir.
Vineet.
In case participants want to ask any question on the presentation made or otherwise, they are requested to queue in their question in the panel on the screen. Now we will begin our panel discussion and also keep taking questions as the participants, we get it from the participants. So I'll take the liberty of starting with Aseem. Aseem, what would be your quick views on the sector in terms of its growth trajectory and the challenges facing the sector before we start getting the questions? Aseem?
So see this sector. If you see the history of this sector, that this segment has grown steadily over the years. There has never been any drama, any growth which has been extremely fast paced and then slowed down, etc. It has grown very steadily over the years. So the segment is a very steady growth segment. I don't think there is anything on the ground that has altered. The stock market sometimes gets excited, sometimes get depressed about things, but the business segment on the ground, the small business segments on the ground that this caters to, is a steady set of business that continues on the and it's March. The good thing is that what the lenders are benefiting from the business getting more organized. And what was earlier happening on the cash side, now coming in with UPI, etc., coming into the banking segment. And therefore, a lot of customer segment, which was earlier not that lendable, has now become lendable because there is access to that much data of the customer. So in the end, in essence, nothing much really has altered. The growth is likely to continue for the sector, what we have seen in the past, or even in a 20-year horizon. There is nothing that I see altering that. Growth will continue. Within that, there will be sometimes, when lending gets a little overexcited, it creates its own bubbles. Those bubbles cools down over time, and credit cost moves up, 5-10 basis points up down. That's part of the cycles. Economic cycles, will play out. But broadly, I would say that I continue to remain cautiously optimistic.
Great. Any views on the challenges facing sector? What are the key challenges that you in the sector?
So one is that see the challenge of this segment remains forever. One is how does one assess cash flows of this segment, and cash flows by one, these segment tends to have erratic cash flows, and they are not that predictable always. And when you're lending long cycles, the customer goes through 2 or 3 cycles. There could be health challenges at the customer's end. There could be family emergencies at the customer's end. So when you're lending long cycles, you will have ups and downs of the customer's cash flows over long cycles. So one is a difficulty, and that is why banks find it difficult to do this segment, and that is why NBFCs like us exist, which have created an expertise of understanding this particular segment, creating an ability to understand the cash flows of this segment, and when dealing with the challenges that come with the segment. The second is that the economic cycles, don't really hurt the segment directly, but if the velocity of money drops, then all segments are affected. So if there's a slowdown in consumption that we are seeing in the economy right now, all the segments are affected. Third is that this segment is also affected by migration, because see, when a Zepto or a Blinkit or all these stuff comes in, ultimately they are hitting the business of these small businesses who otherwise would have been doing this turnover. It's not that new turnover is getting generated. If somebody is ordering chemists, is getting affected. If somebody is ordering medicines online, so some of these businesses are having that extra challenge to deal with. Real estate costs continue to be high in the country, which is a big pressure point for some of these businesses. Unfortunately, the SARFAESI not available for this segment makes the foreclosure on mortgages that much more challenging for the segment. So the challenges remain constant. They've always been. It's not that it's changed. Some of the things have got heightened, but the opportunity continues to be as robust. And as long as you are able to identify the right customers to lend, it's a good segment to build out. It will have its set of challenges.
Great, great. Arul sir, your views quickly.
Thanks, Vineet. I think I pretty much tend to agree with what Aseem was saying, because all of us go through the segment, and I think this segment has been steadily growing. It has not shown a robust growth in 1 year and then down in the other year, primarily because of the complexity of the businesses and complexity in terms of the assessment, which pretty much remains subjective assessment as we speak today also, because there is not much of a digital footprint that he has left with, barring the slow inroads that the UPIs and digital payments are making nowadays. But otherwise, pretty much his cash flow remains, non-digital. I think he still deals in cash, and he still is sub the GST level. So most of the segment of the customers that we are talking about in Micro Lab are people who do transactions through cash, and they live hand to mouth. So anything that happens in the economy, anything that happens in the family, anything that happens in the business affects them significantly. To that extent, I don't know. I, for one, somehow believe that we tend to harmonize borrowing and lending, to the formal segments, and apply the rules of the formal into the informal as well, which to some extent goes to, at times to, detrimental to their interest. In the sense, this segment of customers cannot repay if they don't pay in 1 month, 2 months, 3 months. They can't overnight pay all the months and then come back and become a regular customer. But so he will have to be dealt differently. And I think we need to understand them a little bit, understand their dynamics, understand their cash flow, understand their income earning capabilities. And then accordingly, we will have to deal with them. And there, I think the NBFCs do have a certain amount of deeper understanding of the segment. Though it is becoming challenging as we get harmonized with the various norms. But I think our deep understanding of this, I think for a long time to come, the segment is going to be serviced by the NBFCs, and I think rightly. So this segment will get the credit from the large NBFCs and small NBFCs and medium NBFCs and NBFCs which are going to come, all of them. I think it is a segment which is going to be growing for at least some few more years to. It's going to be at the hands of NBFCs. Yes.
Right, like you said, harmonization of the regulatory framework is a key concern which we keep hearing from different participants in different contexts. But in hindsight, if you look at it, the sector is managed pretty well. The migration from 90-day from in earlier from 180 to 90, right? And now with that harmonization of default being NPA being tagged at 90-day itself, right? So that way, transition the industry has transitioned really very well in that sense.
No, absolutely. I think the companies that are borrowing or we are borrowing the public money, we access the bank money, we access. So I think we need to really be playing by the regulators' requirement. I think we have managed it well, and we'll continue to do well. And the challenges of the segment, the micro lab segment itself, I think when we are talking about it, some of the challenges because some of them now today get denied of the opportunity to borrow because they are actually otherwise a good customer gets classified as a default customer. So in that sense, I think it might be a challenge for the customer. So it may not be so much for the NBFC, so much for the sector, but some of them. But it also over time, what happens is it also makes them also regularize, makes them prioritize, makes them understand like what CIBIL did to the entire borrowing industry over the last 10, 15 years, bringing discipline. I think these things will also make them a lot more allocate reserves, allocate funds to their repayments, prioritize repayments of their borrowings rather than go there and So all these things will actually, in the long run, they will all augur well for the industry.
Right. Moving to you, Mohit, what would be your medium-term estimate of the growth rate for the sector, micro lab?
Yeah, see, one thing which differentiates or which make this segment of micro lab stand apart from all other segment, I would say, is whether bulls or bears, whether lovers or haters, whatever people you would interact, I think they would agree on one thing, and that is the opportunity in this segment. I don't think anyone would have a different opinion regarding the opportunity which this segment offers. So in fact, for some time, we have stopped talking about the kind of opportunity it has because, it runs into billions, it runs into lakhs of whatever, people talk about in terms of debt to GDP, credit to GDP, in terms of untapped potential, in terms of, the formal channel of financing, informal channel of financing. So that is one thing which has already been there. So in terms of growth, I don't see there is any challenge of all sort. We have seen in your presentation how this segment has grown, and that too, we need to understand that in last 7, 8 years, we have seen lifetime kind of crisis. We have seen demon, we have seen GST rollout, we have seen liquidity crisis, we have seen COVID wave 1, 2, 3, geopolitical crisis, rising rate scenario, wherein rates have gone up to the tune of even 3%. Despite all these so-called crises, this sector has grown. I have not seen that this segment has come under pressure in last 7, 8 years, despite these lifetime crisis which has happened. So I don't see any reason that this sector would not continue to grow. The question is, I would say, is not about whether this segment offers the opportunity and how big that opportunity is. I think even if we grow, each one of us, if we grow by fraction of 40-50% growth also if happens, then also we will cover that market segment to the tune of fraction of somewhat up. The real question therein would happen is people who would cater to this opportunity efficiently. The execution, if the execution of some people would be super, some people would be above average, some people would be at average. So the question would be, of course, how efficiently, how diligently, and how in a very, very impeccable fashion you can reach out to that opportunity which is there available with you. So coming back to your original thing, I don't see that, though, of course, I think you have packed that this would continue to grow at some 25% or so. And I don't see any reason that why it should not be growing with that kind of pace. However, having said that, I'm sure this year would be relatively subdued because all those years continuously you can't expand the same way which you have been going. And people who have spent enough time in financial services would agree that every 3, 4, 5 years or so, there is a pause which normally comes, and that is the right time to take a step back, reflect, and course correct, and then go further and see how efficiently you can cater to that opportunity.
Right, we have started getting questions. First question is to Aseem. It's on your book, Aseem. How much your interactions with customers, MSME customers across the country, have influenced your recent book? Anything you want to share on that?
I mean, I have I mean, it's part of the blog that I regularly do, and I made it a point not to make it about work. So while there is nothing about SBFC in it, and it is general conversations, but obviously everybody you meet, and one of the benefits of the business that I'm in is that you meet a lot of people, and people who are real people, across their struggles, the way they build their business. You have a lot of respect that they are doing it against all odds. So while a lot of our large businesses build thanks to the government, a lot of our small businesses build despite the government. So the kind of hardships that they go through, and the kind of attitude that they have to build the business, and to go through life's challenges with a smile. In some ways, we are lucky that we are able to, all of us, play a small role in helping those businesses achieve their dreams a little better. So I would say that no, directly, no, but everybody you meet, tells you a story, and those stories somewhere create a dot. Those dots connect, and some new story comes out of it.
Right, interesting. So Arul, moving to you we hear a lot of discussions on asset quality, especially in unsecured and micro, right? The stress in MFI loans is already out in public domain, and if you look at the PAR 90 data of Bureau that was presented by Jitendra, in LAP the delinquencies has come down by 90, PAR 90 has come down by 200 basis points. Even in micro LAP it has come down by 110 basis point. What, in your opinion, explains these numbers? Because when we look at NBFC data, the trend is not that promising. How do you read these numbers? What's your view?
Yeah, basically, Vineet, I think there was a little amount of an overhang worry that the stress that one saw in the unsecured, which is pretty much the MFI and also the NBFC, which got into some amount of a book in unsecured, even in including Veritas. I think we had certain part of close to about 10% of our book was in unsecured. And the unsecured, we did see in more specific to Veritas. I think we saw certain pockets of our markets, like more so in the urban shopkeeper market, where the availability of loans were very easy, and fintech loans, app loans, and the customer found it very easy to click of the button, borrow something which he found it difficult to repay. So the easy availability, over leveraging led to some of the things in some of the markets that we have present. But that is the same unsecured we have about 140 locations, and in about 35 locations, we are seeing this stress. And remaining in the rural areas, the shopkeepers continue to, behave as they used to, and there is absolutely no difference. There is a worry that this unsecured stress that one we seeing could probably also get passed on to the small ticket size, because micro lab is just about one notch above the bottom of the pyramid, or the microfinance customers. The beginning we were also a little concerned, but I think over the last 9 months to 12 months, what we have seen is actually that has not happened. And I think people treat the secured and unsecured a little differently. People who have borrowed in secured actually are cautious about exposing themselves to more unsecured borrowings, because they see a longer life cycle liability and larger loan liability as a deterrent to going for a smaller borrowings. And we have seen their repayment behavior continues to hold good. We saw a little amount of stress, mild increases in the check bounces in the initial months of the year. I think when we had elections, heat wave, and all of this. But I think that's kind of settled down, and I think there is no further stress that one is seeing. And I think the indications of anything to go by in the last couple of months, I think this has stabilized, and I don't think we see we're going to see any further or any deterioration in the quality of the micro lab book going forward. Having said that, I think there are some challenges here. There's something like what comes in Karnataka. Some of the local factors will probably affect the local book, but there also we are remaining cautious. But so far we are not seeing that impacting the secured book. And in my opinion, I think the secured has held very well, and I think that will continue to be insulated from any of the shocks from the urban and the India from the unsecured.
Okay. And recently, there is a question from the participants here. Recently, RBI came out with some draft circular on pre-closure charges, right? Foreclosure charges.
Yeah.
Does that apply to NBFCs as well, or would it have a significant impact on the ROTA of the NBFCs?
No, I think for NBFCs it doesn't really impact because it was more to do with the the charges are on the we do 80% of our book is on the fixed, and it is only on the floating rate loans that you are doing. And if you are charging and if we are an enterprise, then I think earlier you were using the the pre-closure charges window that is available. Now that has been plugged, and that's more applies more to the floating rate loans. And any organization which has exposed themselves to a large floating rate loans, and there it could have mild impact, but more specifically to Veritas, there is no impact.
Okay, so Mohit, you can take this question. This is largely on formalization of credit to informal segment. So largely the context is with this digital public infrastructure, India Stake, data on GST, Credit Bureau, right? All those things is probably giving a new way to assess credit, right? So assessed income is the theme that even Aseem mentioned, even Arul mentioned it. So assessed income is one part. Then now you have supporting data also to take a credit call on the borrower, right? So all this along with the use of technology, right, at the ground level is enabling a far easier reach to these customers, right? So in a way, the segment which was informal earlier is now getting formalized slowly and slowly. And with trade record getting built, data getting built right, it would probably get inducted into the formal sector also at some point of time. If not all, maybe a part of these borrowers will get inducted into formal this thing. So
Yeah.
with this informal sector getting formalized, right? What kind of challenges or risks do you see?
See, overall, again, coming back to the old thing, it's just like a funnel. See, what happens is when we talk about the opportunity, the data, sometimes people say 1.1 trillion is the kind of gap, 15% of that is getting through formal channel, 84% is still informal channel. So historically, what is happening to some extent will happen now. See, what is happening? First of all, the people who have no access, who have no reach to any formal channel, they start with, say, money lenders. They start with the local people. When they become somewhat informed, they get into formal channels through smaller NBFCs or people who get into, say, micro lab. When they built up something there and have created kind of history and wanted to have a, say, bigger loan and probably expand their businesses or maybe bigger tenor or maybe a smaller rate of interest, they get into, say, bigger NBFCs. When they see from there, they shift it to even public sector, private sector banks. See, this funneling has always happened. It's not that this is something new, and this will keep on happening. So in a way, NBFC is also a kind of conduit for people who are shifting from informal channel to a formal channel. And NBFC is also bringing them to the formal channel. So again, my thought again goes back to that the opportunity is so large that even after happening this is creating a good financial impact overall to the country, that you are helping people come to the mainstream. When they come to NBFC, that itself is coming to mainstream. The only thing is with passage of the time, their rate of interest would come down, their cost of getting a loan will come down. In same way, the NBFC would start getting people from informal segment, and then again, people who are at higher rate of interest would keep on passing to bigger institution for better serviceability or probably better rate of interest. So in terms of challenge, I don't see, because this funneling impact will keep on coming up. The larger chunk will keep shifting from X to Y, Y to Z, and that will keep on happening. And as regards the digital footprint is concerned, of course, this in a way would help all sort of financial institute anyways. It's not that we serve only those customers who does not have any digital imprint. Just to give you the data, 40% of our customers would be new to credit, 60% still would have some kind of data. It's not that if they have the data, they would have easy access to get credit everywhere. Because sometimes it is region, sometimes it is product, sometimes it is the size, sometimes it is a tenor, sometimes it is credit cash flow basis assessment, sometimes it is property, sometimes it is cash flow. So it's a combination of all those things wherein resilient NBFCs or financial services can reach out to customer. And that's the differentiation which different NBFCs created. Some of the fintechs which people used to talk about, some are good, some who have not been doing good. What have been the difference? The people who have not been doing good in those fintechs, fin was less and tech was more. And the people who have been doing good, there the core was fin and tech was surrounded, and that was enabling environment for them. Just to give you an example, good number of NBFCs now have started using all those India stack, all those APIs, all those credit bureaus. The seamless, the logins have happened paperless. The decisioning and the flow of the files have been ably supported by those kind of modules, which helps you. The triggers have started coming in. The collections have become, say, digitalized. Those payment banks, those ENACH, and all those things are helping you. So, in all that perspective, of course, this is helping all financial institutes, irrespective of their size, irrespective of their segment. But in terms of opportunity, since that is humongous, this shift will keep on happening, and that does not pose much of a challenge.
So essentially, you're saying that each customer will its own journey from informal to NBFCs to banks. That's the journey that each customer will have, and new customer will get into fold of all NBFC, etc. That would probably keep the momentum going. That's essentially you're saying.
Yes, and that is sometimes good also. Just to give you an example, if I have assessed a customer for 5 lakhs and in future his eligibility becomes, or say if he wanted to take 15 lakh or 20 lakhs kind of loan, it does not mean that he has, shown a track record to me for 5 lakhs for 5 years. That does not naturally mean that I should give him 15 lakhs or 20 lakhs. My risk appetite, my other credit considerations would be relatively different from say bank or from say a bigger NBFC that way. So sometimes it is good that some customer, you should definitely happily letting them go for a different exposure, for a different tenor, from asset liability mismatch perspective, from any other perspective as well. It's not that one should look that as a kind of challenge.
Interesting. Aseem, your views on the same issue?
See, the basics of lending is that risk and return will always go hand in hand. So there's a reason why prime home loan is at 8%, and micro LAP, can be, at 18% or even higher. There's a reason. The reason is that there is a higher risk, involved in that lending. There is a higher operating cost, as your average ticket sizes come down. And therefore, you are operating in an environment where both your operating costs are higher and your credit costs are higher. And being an NBFC, your cost of funds also will be higher than that of banks. So when you combine all these 3 things together, you have to make your margins after that. In this segment, the pricing is good enough. The good thing is that the all the competitors, while there is competition on the ground, there is the reality of multiple players. Competition has been sensible in terms of pricing. I don't think there's any player out there undercutting rates. And as long as there is sensible pricing happening, the additional risk of this segment is priced in. And this segment will have, I mean, the higher rate you get is for a reason. It is not coming to you free. You are taking that incremental higher risk on the lending, and therefore you will have an incremental higher credit cost compared to prime, credit. So to that extent, one will have to keep in mind, that lenders in this segment, are lending at a high rate because they are cognizant of the risks involved in the segment, and all the challenges that come, in the segment. As long as you sensibly manage your operating cost, your cost of funds, and keep the credit costs contained in a tight leash. It's a great business to be in, and people have built this business over the years, and that is one of the moats that you have against organized competition like large banks. That it is very difficult for, having been part of a large bank in my past life. I know that it's almost impossible for a large bank to have aspirations to compete in this segment. And as an NBFC, you want to identify a segment that is in the rain shadow of a private sector bank, because you cannot compete with them head on. So there's a reason why this segment exists within the NBFC, and then it's about how you execute, within this segment. Because ultimately, while a business may have opportunities, there are also landmines in this business. So as long as you're able to balance the risk and the return trade-off, it's a great segment to be in, and there is the drama is much lesser, because the customer segment that we deal with, is doing bread and butter things. They're not really concerned much with the way the economy is moving or whether India is booming or not. Is the small town India expanding better than the big metros? The answer is yes. Is it that the middle class, as a segment, is growing across these small towns? The answer is yes. Is it that India has completely done away with the abject poverty that we were part of? The answer is yes. Sometimes our media makes us too pessimistic, too biased. But the fact is that on the ground, the people are aspiring for a better life. They are aspiring for more access to formalized credit, and grow their business. And if you are able to participate in this, fully knowing that it has an elevated risk involved, it's a good business to build in, and then it depends on how you are executing it.
True, you said it nicely. Actually, negative news sells better than the positive news. So that's how the narratives would get created always. So there are a couple of questions I read out, then maybe one of the panelists can take it. Operational challenges in enforcing security for micro lab given absence of SBFC, then prepayment is already taken. Asset quality for less than 5 lakh ticket and 5 to 10 and higher than 10 are this different? Probably yes. Maybe Arul, you can take first question on SBFC, and then Mohit can take question on asset quality for less than 5, 5 to 10 and more than 10.
Yeah, thanks, Vineet. I think the surface, I think the answer lies in pretty much what Aseem was trying to was articulating. Actually, see, the segment has its own risks, its own rewards, and I think there is no reason why the pricing in this segment is slightly higher than the formal segment. And despite you having the security, the title deed, the product, the properties that are that you are taken as hypothecate are not marketable. So I don't think you can sell the property of a micro lab segment and then realize you are because not only because you don't have a surface, even if you had a surface for a 10 lakh property or a 5 lakh property or an 8 lakh property that you take as a security in a village, that's not clearly marketable. So in that sense, the security is more a moral threat, and it's a self-occupied residential property. The customer doesn't want to let go. So ultimately, the realization and the coming out of a non-performing asset is going to be determined on the ability of the customer to bounce back, ability of the customer to manage and then get rid of the account. So it pretty much depends on the way you approach. I think at Veritas we have always been taken a route that we'll be a lot more compassionate about it than because we know the segment that we are dealing with does not pay, not because they don't have the intent to pay, they don't have the ability to pay. That's why they you don't get your money. So, you don't want to push the customer back again to the in a peril, and the way we approach a customer will be slightly different. So, not having a SFRC is by itself is not a deterrent. I think the security in itself is also not a security which can probably help you realize and then come out of it. The story is slightly different when you go and do affordable housing loans, which we also do. And in there, the security is marketable. The security has SFRC protection available. So the customers who come, even if they don't come, we can probably sell the property and then come out of it and with a minimal loss. So the way we approach the micro lab customer sub 10 and the way we approach a housing loan customer is slightly different. And to that extent, I think the products are also priced in accordingly. So our credit cost assumptions, guidance to the investors and everyone also keeps in mind and reckons this risk that is involved in the micro lab segment. And I think with this cost included, I think it is still, as Aseem was saying, it is still a great business to be in, and it is a execution business. It is actually you can you can run a very, very profitable business while being compassionate to a customer who is not paid well as well.
Great. Mohit, your thoughts on average ticket size and delinquency levels?
Yeah. See, normally I hate to tie anything in a general perspective, saying that this profile is good, this profile is bad, this location is good, this location is bad, and same goes with the ticket size. Because what happens is the average ticket size in Delhi, Mumbai, a remote corner of Rajasthan, Jharkhand, Chhattisgarh would be different, So it is basically your credit assessment. It is basis your credit templates. This is basis how you have approached that customer. Having said that, generally, two things we have seen. One, if you go much below in terms of ticket size, two things happen. We have seen as a human psyche. The credit manager becomes relatively relaxed, saying, oh, this is a 2 lakh customer, this is a 1 lakh customer, probably we waive off couple of conditions. We don't see those things or referrals, we can waive down what normally we see. So that is one. The credit system tend as a human psychology get a little bit relaxed. That is one. Second, we have seen even in collection efforts also. What happens is if a collection executive is given, say, 50 cases, if he would have 20, 30 cases of less than 3 lakhs, and if he would have 10 cases, say, upwards of 10 lakhs or something, he try, as a human psychology, he try to, go to those cases first, wherein the ticket size is relatively more, wherein the less effort and more results can come in from human psyche perspective. And second, I have seen that, the larger the ticket size, normally it would become difficult to do a cash flow analysis on that. See, just to give you example, it would be very difficult, or it would be next to, impossible to judge a customer who wants, say, 70 lakhs loan, and you would want to appraise him on a cash flow analysis. If he want that big loan amount, he have to have some kind of trails. He have to have some kind of documents which can prove him worthy for that. So from those perspective, of course, somewhere in the middle is always good. You can't do a cash flow analysis for a bigger ticket. You should ideally avoid doing a little less kind of loans. So from that perspective, otherwise, I remain with that philosophy that it is a credit underwriting which is there, which differentiates a quality, rather than brandishing that, carpenter is good, chaiwala is bad, or something like that. So you can't define that way.
Essentially, are saying the credit underwriting and focus on underwriting and probably collection that would drive rather than the ticket size in absolute, because ticket size in different geographies may have different connotations, right?
True.
Aseem, to you, basically, all the panelists talked about dependency on cash collections and cash flow being a bit erratic. In that context, the question is, how do you contain this risk, and what proportion of your collection is auto debit, versus case collection? Maybe it's too a specific information. Maybe you can give a broad range from the sector perspective and not the entity perspective. Another question is what kind of EWS do you build when the cash flows are volatile, and how do you control the over leveraging after disbursement? So too many questions in one question.
No, see, what one thing is that the customer also has matured, and now we have come a long way from where customers did not even have a bank account to where it is today, where every Indian now has a bank account thanks to Jan Dhan Yojana. So to that extent, the we have come a long way. Cash is now a depleting part of the system itself. So, for example, a company like us, I mean, while everybody does electronic presentations through NACH. All our customers are presented on NACH. Even customers, that their NACH bounces. Electronic QR codes and Bitly links are sent out, and almost 98% of our customers pay electronically. So only about 2% customers remit cash, which also is a number that we are steadily working on to getting it down to zero. So one is that the customer segment has also matured. Second is that while assessing itself, you'll have to understand that the EMI component has to be comfortable to what the customer can pay, because that the customer will have and see, we have done studies where how the if the EMI is 15,000 rupees a month, if the EMI becomes 20,000 rupees a month, the probability of default almost goes up by 20%. So it is you keep this in mind, that as much as possible you keep the EMI at a comfort zone, which is where longer tenures are given out, even for shorter a smaller amount of loans, because the amount may look small to you as a lender, but from the customer's viewpoint, it's a largish amount. So to that extent, you have to ensure that you keep your EMI the size of a sachet and not the size of a bottle, because bottle shaped anything in this country is difficult to distribute. So you keep your EMI the size of a sachet. As long as you do that, you're able to get by. The challenge is that the customer segment does not have the ability to, if he slips, the ability to bring back the customer is that much more challenging. So once a customer slips and moves ahead in terms of buckets, the customer's ability to pay 2 EMIs or 3 EMIs is very, very challenging. So when a customer moves ahead, the problem is that unlike in prime lab, bringing the customer back is a lot more difficult than it is in prime lab. So you keep that in mind and ensure that you try and keep the customer as close to current or maximum into 30 as possible, because beyond that it becomes difficult to contain the customer. Also, and that is the challenge. The portfolio, you keep it on a CIBIL watch, so you are aware when a customer makes an inquiry with a lender, if the customer is looking for extra facility, and you at least are aware that the customer is looking and can understand what is the reason, and then decide whether to exit the customer or there is a stress developing that you will have to address. However, in a lending business, once you have given a loan, you are pregnant with it. So sometimes you may even realize that the customer is building velocity of credit, and it's a slow train wreck that you see coming your way, but there is little that you may be able to realistically do except speak to the customer and try and keep the leverage not going up. So the trick is really in terms of how you are able to engage each customer that you have, because there is a fair amount of touch and feel even in terms right from the time we are originating a customer to the time that we are collecting. There is a boots on the ground for both origination, credit, as well as collection, and it is the intense follow up that one does to keep the portfolio healthy. Challenges are known. Some of it you are able to solve. Some of it you try your best, but ultimately, if the customer doesn't have the ability to pay, that will be part of the stress. Again, as I said, as long as you keep it range bound, some of it is par for the game. You will not have a situation here. You cannot have a situation that you have a rate of interest that is 3 times prime mortgage and a credit cost which is not equivalent. So you will that same multiple will move every 2% increase. See, you will see this in lending, that every 2% increase in interest rate moves your credit cost significantly. If a prime home loan credit cost is 20 basis points, calculate from there every 2% increases as you go along, and you will see that your credit cost moves in that direction. So but if your rate of interest, as long as you are not mispricing your risk, and as long as you're not taking risk which is beyond the range that you have priced it for, you will come out okay. Credit cost in some years maybe 20 basis points higher, some year it may go 20 basis points lower. Post COVID, we had gone to an abnormally low credit cost as an industry, as a banking industry. And is there going to be a reversal to the mean? Of course, because everybody cleaned up their balance sheets in COVID, and a new set of lending happens. And as we know, the bill of lending comes only after 3 years. Till 3 years, everything looks beautiful. So some of that bill has started to arrive this year, and the industry will see a higher credit cost. However, as long as you are smartly managing your margins, keeping your cost of funds tightly under leash, keeping your cost of operations under control or reducing as much as possible, and containing your cost of credit, you will come out okay in terms of your ROAs and ROEs, and that's ultimately the business you are in.
So there are 5, 6 questions. If you guys are fine, we can stretch it by 10 minutes. We can quickly take questions. One is there is a question on presentation that why is 10 lakh plus loans have higher delinquencies than micro loans? Is it because of poor assessment, or the intention of the customer is relaxed till 90 days, or it is relaxed after 90 days? So maybe I can reflect on that, and then if you guys want to add, you can add it. That data pertains to only NBFCs. So in micro lab, the competition from banks is little lower or probably not there. So they have choice in terms of assessing the credit. In lab segment, there is a competition from banks. So the cream customer probably will go to the banks to get better rate, and there is slight adverse selection, for lack of a preferred word, when it comes to lab high ticket, last ticket lab when it comes to NBFCs. That explains the high delinquency in 10 plus lakh loan segment. I don't think it has anything to do with poor assessment or relaxed intention of the borrower. Is that fair, or you guys want to add anything on that question? Arul?
I
Is
think
that okay?
broadly most of what you said is right, Vineet, but I think we don't have much of a 10 lakh plus lab. But however, I think one of the reasons why we don't is because the reason a sub 10 customer does not get credit from the banks is because of inability. And I think he's not credit. It's not that he's not a
Right.
credit worthy customer. Whereas a 10 lakh plus customer, if he doesn't get a credit from a bank, it may not be because he's a good customer and doesn't get. Maybe it is because there are reasons which are valid, and probably
Right.
I think the deviation that one tends to take in the sub 10 segment may be necessitated by various other reasons which are fair, and whereas when you go to about 10 lakh segments, I think something that you doesn't meet the eye, then you miss it out, and NBFCs are not better placed to meet those deviations. That could probably play it out. This is my guess, but that is one of the reasons why we always stay away from an about 10 lakh segment, because that's something that I think it's not the market that we would like to address. We'd like to address the credit gap in the sub 10 segment. So that's where our skill set lies.
Right. Two questions are which are, I think, in my opinion, already addressed. One was Karnataka ordinance and impact on collection. Second is overlap with microfinance borrowers and potential impact on microlab. I think both were addressed partly by, I think, one of the panelists, Karnataka ordinance and overlap with microfinance. My understanding from the panelist is that MFI stress is probably the migration or the impact on the secured asset class is muted at this point of time. Karnataka ordinance, again, the impact is slightly there. Mohit, you want to take this? Anything you want to add? on these?
Two things. One, of course, this Karnataka ordinance primarily is related to that informal segment, and to some extent, even if it talks in terms of languages, it is to MFI in a true sense. However, having said that, this creates some kind of opinion, this creates some kind of news, this creates some kind of framing of what is happening in this segment. So these things create some kind of bad impact overall. But if specifically, if you ask me, this is not that large a thing which is impacting overall, apart from that environment which got somewhat created. So that is what my limited scope on this is. And regarding that MFI overexposure or over leveraging, see, howsoever we say that segments or countries or whatever, they are decoupled, it is impossible not to have any impact. The relativity could be high or low. We may say that we are relatively immune, and microfinance or personal is somewhat different. But what happens is, money in the hand of people, the earnings, the kind of ecosystem it creates, the kind of news which is spread, tightening people, and kind of where overall the defaults start rising. This, emanates from one place to other to another. So relatively, overall, specifically, if you ask me, it is secured is immune from that way. But having said that, any impact there, of course, would have some impact here. It cannot remain completely immune. So some impact would be there. The only thing is the extent which you can talk about, that will remain relatively muted as compared to probably the unsecured segment.
Right, Aseem, there is a question on end use. How is end use checked? Maybe you can address that, and also address that from regulator perspective also, there is increased focus on monitoring the end use. Being an NBFC, how easy, challenging, or possible would it be to monitor the end use?
We have now, started signing up our customers for account aggregator, and with their permission, are able to extract bank statements, through the life of the loan. So even though you get the bank statements, it is not always easy to specify, because money is fungible. Where the money has gone over the life of the loan. Even as a banker, I've always struggled with exactly pinpointing end use in a customer segment. So it is a challenge. We are trying to do our best to ensure that we are able to have some sort of a idea of where the money is going. However, through the life of the loan, it is difficult, because money keeps going in and out of the account, and the customer is not accountable to you once he has taken a loan from you. So your ability to actually reach out back to the customer and understand where all the money has gone is limited. However, that is the regulatory ask, and we have to do our best to ensure that we are in compliance. We are trying to do our best to make sense of the end use of that money using the account aggregator pull of bank statements. However, it is a work in progress, and I wouldn't say it's a foolproof mechanism that we have yet developed to ensure that the end use is exactly what it has been stated. Also, what it is not clear is that if the end use is different, what are you supposed to do? That we don't have an answer for.
True. And we'll probably take last question, which is, if you look at the sector, it's poised for a growth in the near future. The delinquencies also are reasonable. ROTA is getting generated at a decent. There is a lot of interest from the PE guys in the sector. And as we discussed in the panel, there is more interest of private sector banks also in the segment. So all these will eventually lead to higher competition and compression in the margins, right? So how do you see the margins getting impacted if and when the competition increases? And are there thoughts around maintaining the margin, or migrating different sectors to maintain margin? What's your thought on that? Maybe Mohit or Arul can take it.
See, two, three things here. One slightly different data point, and then I'll connect it with this question. See, 2020, we need to see overall trends, overall signals, and how the shifts are happening, and then try to connect our ecosystem. See, 2024, that year is marked for the first time since independence, wherein the household expenditure on food fell below half of the total monthly expenditure. So this is taking a trend that people earlier who were spending more than half of their expenditure on food, now it is coming down. Means where are they spending now? So it is beyond food. So see, this also relates with the credit demand gap, the opportunity demand gap, and how the signals, the SIP. Of course, if you talk about last couple of months, the rejections are more than the acceptance. But broadly, if you see the trend, how people have got into, so these things, suggest you the shift which is happening, the digital pace you spoke about. And then now coming back to your question of, the margins, if we see the so-called competition from the opportunity sizing, that appears there is no competition from that opportunity sizing. But of course, if you go in the field or if you go in market, and then you realize, some opportunity somewhere wherein the challenge appears in terms of competition and then the margins. So first of all, till now, there is a robust interest which is coming in from PE players because of opportunity sizing and the kind of ROE and ROA this segment gives. We need to understand even now, when the rate of interest has gone up 3%, still the margins are protected. I have not seen the margins have squeezed in the same fashion the way the cost of funds have gone up in last 1 or 2 years. Most of the people are still at that juncture wherein they could easily consume that rate of increase which has happened to the tune of 3%. Imagine a situation when the rate would start declining, the cost of fund would start declining. So good number of financial institutions would have, of course, some competition here and there, but still the opportunity to either pass on or increase that margin would still largely remain with those people. And that is what we need to understand, because people say that banks and all those people would come into this sector. We need to understand MSME has a large definition. When even banks are coming to this sector, they are not into 3, 4, 5 lakhs kind of loans. Probably 15 lakhs loan, 20 lakhs loan also would fulfill that MSME kind of criteria. And banks are more focused on that because of OPEX reasons, because of efficiency reasons, credit cost reason, and how their templates and how they would want to grow. So I don't see much challenge happening there, at least in foreseeable future.
Arul, your views?
No, I think in terms of the potential in the segment, I keep saying this, Vineet. I think there is no need to be worried about competition at this point of time. In my mind, I think there's more and more players who need to come in to serve this underserved segment. If you are, just to give an example, as I keep telling all our people, we have in India 7.5 crore people who file IT returns, and for addressing the needs of housing needs or the business needs or the loan needs of the 7.5 crore people, there are companies which have built 3 lakh crore or a 4 lakh crore balance sheet size, right? And if you're talking about people who don't file IT returns, which are pretty much the people that we are addressing, who could be anywhere between 20 to 25 crore households. And this segment has not yet seen even one single either MSME company or in the affordable housing space by anyone who has built even a 50,000 crore balance sheet, right? So I think we are now talking about competition maybe about 5 years, 6 years, 7 years away. I think there is enormous amount of underlying and latent potential that we need to address. And so we are far away, so there are players in this industry, but there is no competition. That's what we see. We all sit in the same town, same building, same floor, and sometimes, next to each other, but we don't know each other's customers, right? So a customer does not bargain from us saying that I'm getting so X percentage from so-and-so, X percentage from so-and-so. No, what is your rate? I think we are very, very far removed from that. We are only going there, meeting the customer, understanding the need and addressing their need. So in that sense, the potential in this segment is huge. And I think we will have to just keep on working on, addressing their needs. And in terms of, talking about the margin squeeze, I think if anyone understand the nuances of the segment, what is the requirement complexities in this addressing this business, if they understand the OpEx, if they understand the credit cost, if they understand the margin, then I think the pricing is going to be not any different from what it is today. And that is one of the reasons why most of the players, despite many more players coming into the segment, the price remains, the interest remains what it is today.
Interesting. So basically, there is space for all. Cautiously optimistic is what the mantra is at this point of time.
Absolutely, the execution is going to be making the huge challenge, and that's a huge difference. Yes.
So there are a few questions which remains unanswered. So people whose questions didn't get answered probably can connect with us separately. We'll try to address them. I will conclude this panel discussion. We have already exceeded by 15 minutes. Thank you, Arul. Thank you, Mohit, for joining us and sharing your insights with us. Thank you.
Thank you. Thank you very much.
Thank you so much. Thanks.
Thanks for having us. Yeah, thank you.
Thank you.
Thank you.
Thank you, Vineet, for moderating the session, and Jitendra for your presentation. Once again, thanking all our guest speakers for their insightful views. It was a privilege to host you. And lastly, thank you to all the participants for taking the time out and being a part of this CareEdge webinar. For any further queries, feedback, or suggestions, please write to us in feedback mail. Goodbye for now. Request the tech team to log off kindly.